Hello traders, Gary Wagner here just before 12 noon in Honolulu, 6 o'clock in New York. It is Wednesday, Fed Day, October the 30th, 2019, and this is the Daily Report for Gold and Silver. As anticipated, the Federal Reserve began a meeting yesterday, which concluded today, and announced immediately following the conclusion that they had implemented a third rate cut for the year, a 25 basis point or 0.25% lower move. That was a bullish move for both gold and stocks. We're looking at the aftermarket with gold at $1497.50, up 80 cents. All things being equal, there was a gain of about $6 or $7 on the day, or about 0.5%. Silver itself is currently trading at 1786.5. And the other market I do want to look at, of course, is the U.S. equities markets, with the Dow closing up 115 points at 27,186. When we look at our price board as well as our technical studies, I will define why I made the decision not to pull the trigger and go long gold. There are a couple of particular circumstances that I need to see this market overcome first. But first, let's take a look at our technical studies. So traders, I do want to look at two different time cycles today in gold, a daily and a very, very short-term 5-minute, this being the Japanese average or Heikin Ashi chart. We can certainly see that there were some wild gyrations, fairly flat going into the meeting. And as the meeting comes out and a statement is released, this 8:30 represents that time point. We initially had a drop. That drop took gold from roughly 1496 to today's low at 1483, and then a pretty swift recovery to a high above where the market had been trading at prior to the fall, and then we sort of leveled out throughout the remainder of the day with gold at 947.50. We are now looking at the same time cycle, although this in candlestick format. Remember, the primary distinction between those two charts, the Japanese average and candlesticks, is candlesticks uses a true open, a true close, a true high, and a low, whereas the open in a Heikin Ashi chart is fixed at the midpoint of the prior candle. That's why it averages it out. So what we see when we look at this type of chart, we had that same strong V formation, no doubt about that. However, we can see that the majority of candles didn't have the same size move. We had a couple of big clips and smaller candles throughout the way. But the real tell of the tape, so to speak, can only be visible on a daily chart. Even with today's solid $7 upside move, as I mentioned in our opening statement, there is a reason that it did not trigger a buy signal, and I want to go into some detail about it. First of all, the entire range of the day maintained itself within this compression triangle. You can see it opened within it, it closed within it. It did have a low that went below it, but for the most part, trading activity maintained within the compression triangle. What I would have needed to see to issue a trigger and buy the market would be a break above this current resistance line. It did not. The second reason is at least what we needed to see was an effective close above $1,500 per ounce. We did not see that either. So my question is this a one-day wonder, or really the beginning of that next rally, which would be a fifth wave? My sense is that with estimates currently coming in for Friday's jobs report and the fact that they are tepid, that should give us the final kick in momentum to break above these levels. And traders, if that occurs, I will send out a special trade alert. You can always act on your own under the parameters that we have this market trading above 1,500 and or this resistance line on a closing basis or very close to the close. This is Big Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.